car market crash of 2025 is unfolding right before our eyes, with rising prices, unsold inventory, and sky-high interest rates wreaking havoc. Dealerships are drowning in costs, automakers are laying off workers, and buyers are left wondering if they'll ever afford their next car. But what does this mean for you? Will prices finally drop enough to make buying worthwhile? Will dealerships survive the storm, or is this just the beginning of a larger collapse? What's happening? The car market is reeling from a convergence of economic forces that few could have anticipated. For years, manufacturers enjoyed booming sales, buoyed by cheap loans and pent-up demand. But now, the tides have turned. Buyers walking into dealerships are hit with sticker shock, facing prices that have ballooned by over 42% since the year 2019. Imagine walking onto a lot, eyeing a once affordable truck, only to find the same model now priced closer to $85,000. The affordability gap has widened, leaving many buyers out in the cold. Interest rates, once a buyer's ally, have become a formidable enemy. The average rate for a new car loan has climbed to a staggering 7%. This translates to monthly payments that are increasingly out of reach for the typical consumer, often surpassing $760. And then there is the issue of negative equity. On average, buyers owe over $7,000 more than their cars are worth, creating a vicious cycle of financial strain. These factors have combined to create what can only be described as a perfect storm for the automotive market. But the problem goes deeper than rising prices. Banks are growing increasingly wary of extending credit. 1 out of every 5 auto loan applications is denied outright, shutting the door for many hopeful buyers. This tightening of credit is not just a statistic, it is a reflection of the financial pressure mounting on everyday Americans. The storm brewing in the car market is no longer about the cars themselves. It is about the crumbling financial infrastructure that underpins the entire industry. Inventory piling up. The scene at dealerships across the country is almost apocalyptic. Rows upon rows of unsold vehicles stretch as far as the eye can see. Inventory levels have swelled to over 3 million unsold cars in the United States alone, a 120% increase since 2023. This oversupply is not limited to lesser-known models or obscure brands. Iconic vehicles like the Ford Bronco, once a symbol of rugged adventure, now sit idle for over 200 days on average. Even the smaller Bronco Sport models, marketed as a more accessible alternative, remain untouched for over 220 days on dealership lots. The Hummer electric vehicle, hailed as a technological marvel when it debuted, tells a similar story. Dealerships once charged $20,000 to $30,000 above the manufacturer's suggested retail price for these vehicles. Today, those same dealerships are slashing prices by tens of thousands of dollars, yet the Hummers remain unsold. The irony is hard to miss. Vehicles that were once in high demand are now symbols of an industry struggling to adapt to changing market dynamics. This inventory crisis is not just a logistical headache, it is a financial catastrophe. Unsold cars represent dead weight for dealerships, driving up costs while providing no return on investment. The ripple effect is being felt far beyond the lots, with automakers scaling back production and laying off workers. Assembly lines across the nation are slowing down, a stark reversal from the frantic pace of production seen just a few years ago. Bank denials and credit crisis. The financial strains on the industry are mirrored by the struggles of individual buyers. One of the most telling signs of a market in distress is the rising number of repossessions. In the past year alone, repossession rates in the United States have surged by 23%. This alarming statistic reflects a deeper issue. Many buyers are simply unable to keep up with their payments, with the average payment for a new car exceeding $760 per month and used car payments averaging over $525. The financial burden has become untenable for many households. The tightening of credit is another major hurdle. Banks, wary of defaults, are denying 1 in 5 auto loan applications. Even for those who manage to secure financing, the terms are far from favorable. Interest rates for used cars have climbed to an average of 11%, making it nearly impossible for buyers to justify the cost of a used vehicle compared to a new one. The math is unforgiving. A $50,000 new car at 7% interest is often cheaper in the long run than a $42,000 used car at 11%. This credit crunch is not just an economic issue, it is a societal one. Families are being forced to rethink their transportation needs, turning to cheaper, less reliable options or delaying purchases altogether. For the average consumer, the question is no longer which car should I buy, but rather, can I even afford a car? A global issue. While the crisis in the United States is particularly pronounced, it is by no means an isolated phenomenon. Around the world, automakers are grappling with similar challenges. Volkswagen, a global giant, recently announced plans to lay off over 35,000 employees by the year 2030, citing declining sales and rising production costs. Nissan is not faring much better, with over 9,000 job cuts scheduled for the upcoming year. Even luxury brands like Mercedes-Benz and BMW are reporting record profit losses, signaling that no segment of the market is immune. The electric vehicle market, once seen as the savior of the industry, is facing its own set of challenges. Companies like Rivian and Lucid, which were once heralded as disruptors, have seen their market shares plummet. Rivian alone has experienced a 55% drop in its stock price over the past year, while Lucid has fared only slightly better with a 48% decline. Despite heavy government incentives and tax credits, sales of electric vehicles in the United States have stagnated. The promise of a greener future is clashing with the harsh realities of affordability and infrastructure limitations. This global context underscores the interconnected nature of the automotive industry. A downturn in one region ripples across the supply chains and markets of others. For consumers, this means that the car market crash is not just a local event, it is a global reckoning with implications for jobs, technology, and the very way we think about transportation. The Unsold Lot Crisis. Drive past any dealership today and the sight is impossible to ignore. Sprawling lots packed with unsold vehicles, some even spilling over into grassy fields or auxiliary lots. This backlog of inventory, unprecedented in scale, is a stark indicator of the challenges facing the automotive market. More than 3 million vehicles remain unsold in the United States, a dramatic increase since the year 2023. Among the hardest hit models are high-ticket vehicles like the Ford F-Series trucks and Ford Broncos. The latter, a vehicle once celebrated for its return to market after years of absence, now languishes on dealership lots for over 200 days on average. Even more compact options like the Bronco Sport, aimed at budget-conscious buyers, are seeing similar stagnation. The problem is not just supply, it is price. With some Broncos carrying price tags exceeding $70,000, consumers are simply walking away. This unsold inventory creates a ripple effect throughout the industry. Dealers must cover the costs of holding these vehicles, including lot fees, insurance, and interest on loans used to purchase the inventory. These flooring costs compound over time, creating immense pressure on dealerships to offload vehicles at steep discounts. For many dealers, the choice is stark: sell at a loss or risk bankruptcy. The price tag problem. It was not long ago that $50,000 was considered a reasonable price for a well-equipped pickup truck. Today, that same truck is often priced closer to $100,000. This sticker shock is pricing out a significant portion of the market, particularly middle-class buyers who traditionally drove sales in this segment. Even mid-size vehicles, which were once seen as an affordable alternative, are now crossing the $50,000 threshold. The pricing problem extends to used cars as well. Historically, buying used was the more budget-friendly option, but skyrocketing interest rates have changed the equation. The average interest rate on a used car loan now hovers around 11% compared to 7% for new vehicles. Over the course of a typical 72-month loan, this higher rate can result in the used vehicle costing more than its brand new counterpart. The math is simple but disheartening. Affordability has become a thing of the past. For the average consumer, the implications are clear. High prices, compounded by rising interest rates, mean that car ownership is becoming increasingly out of reach. Families who once purchased vehicles with ease are now forced to consider compromises, such as opting for smaller, less feature-rich models or delaying purchases altogether. Incentives and discounts. In a desperate bid to clear inventory, dealerships are slashing prices and offering unprecedented incentives. Vehicles that once carried substantial markups are now being heavily discounted. For instance, the Hummer electric vehicle, which not long ago was selling for $20,000 to $30,000 above the manufacturer's suggested retail price, is now being offered with discounts exceeding $30,000. Similarly, Jeep Wranglers and Toyota Tacomas, both historically popular models, are now coming with rebates of $6,000 to $8,000 or more. Even full-sized SUVs like the Ford Expedition and Chevrolet Tahoe, which typically hold their value well, are seeing dramatic price reductions, with some dealerships cutting up to $10,000 off sticker prices. These discounts may seem like a boon for buyers, but they come with a hidden cost. Slashing prices erodes the perceived value of a brand, particularly for vehicles positioned as premium products. When customers see steep discounts, they begin to question whether those vehicles were ever worth their original price tags. For manufacturers and dealerships alike, these tactics represent a double-edged sword. While discounts can temporarily boost sales, they also undermine long-term profitability and consumer trust. Buyers who purchased at full price only months earlier may feel alienated, while future buyers may hesitate, expecting prices to drop further. Incentives are not limited to price cuts. Many dealerships are offering financing deals to entice buyers, such as 0% interest rates for limited terms or extended loan periods. In some cases, dealerships are combining these financing options with cashback offers or deferred payment plans to sweeten the deal. While these offers can make vehicles seem more affordable in the short term, they often mask the underlying issue of inflated prices. Buyers may save on interest or upfront payments, but they are still paying a premium for vehicles that were once far cheaper, creating a false sense of value and perpetuating the cycle of market instability. The electric vehicle bubble bursts. Electric vehicles were once heralded as the future of the automotive industry, a beacon of innovation and environmental consciousness. Yet the reality on the ground tells a different story. Despite significant government incentives, including tax credits and low-interest financing, sales of electric vehicles have stalled in the United States. Rivian, once a darling of the electric vehicle market, has seen its market share drop by over 55% in the past year alone. Lucid, another promising contender, has experienced a similarly sharp decline. One of the primary barriers to electric vehicle adoption is infrastructure, or the lack thereof. While urban areas have seen a growing number of charging stations, rural regions where many truck buyers live remain underserved. For a farmer in Kansas or a contractor in Montana, the fear of running out of charge far from the nearest station is enough to keep them from making the switch to electric. Price is another critical factor. Electric vehicles are often positioned as premium products, with starting prices that far exceed the budgets of most buyers. For instance, the Ford F-150 Lightning, an electric version of the best-selling pickup truck in America, carries a price tag approaching $90,000 when fully equipped. Even with discounts and incentives, the cost remains prohibitive for many consumers. This stagnation in electric vehicle sales has broader implications for the industry. Automakers have invested billions of dollars into electric vehicle production, banking on strong demand to justify these expenditures. As sales fall short of expectations, these investments are increasingly looking like risky bets. The question now is not just whether electric vehicles will succeed, but at what cost to the broader industry. Dealership greed. At the height of the pandemic, dealerships across the country became emboldened by a wave of demand and limited supply. Vehicles were flying off the lots, and some dealers capitalized on this frenzy by adding steep markups. Pandemic-era greed saw many dealerships charging tens of thousands of dollars over the manufacturer's suggested retail price, confident that desperate buyers would pay. Now, those tactics have come back to haunt them. The goodwill they burned during those years is hard to regain, and the current market crash has exposed how unsustainable those strategies were. Dealerships that once thrived on inflated markups are now struggling to move inventory, even with significant discounts. Buyers are far more cautious and less forgiving. The message is clear: the era of unchecked dealer markups is over. However, greed persists in some corners of the industry. Even now, some dealerships refuse to lower prices to levels that align with market realities. Instead of cutting losses, they cling to hopes of government bailouts or a sudden surge in demand. But as inventory continues to pile up and loans become harder to secure, these dealerships are running out of options. Their refusal to adapt is becoming their downfall. Automaker missteps. While dealerships bear much of the blame, automakers are not without fault. Overproduction has become a glaring issue, driven by outdated strategies and poor market predictions. Manufacturers ramped up production in response to the shortages experienced during the early days of the pandemic, failing to anticipate the dramatic shift in consumer buying power that followed. Take, for example, the Ford F-150 Lightning. Initially hailed as a groundbreaking electric vehicle, it was priced aggressively high, with top trims nearing $90,000. The same story unfolded with other models, such as the Ford Expedition and Chevrolet Silverado, which now sit unsold despite heavy discounts. Automakers overestimated demand and underestimated the financial pressure on consumers, resulting in a glut of vehicles that no one can afford to buy. Another key misstep is the focus on premium pricing. In their push to improve profit margins, automakers have increasingly positioned their vehicles as luxury items. Even traditionally affordable models like the Toyota Tacoma or Honda Civic now carry price tags that are out of reach for many buyers. This shift has alienated a significant portion of the market, leaving automakers scrambling to recapture lost ground. Government influence. The role of government policies in the car market crash cannot be ignored. Tax incentives for electric vehicles, once a major driver of sales, are now being scaled back under changing political leadership. For automakers that have heavily invested in electric vehicles, this is a significant blow. Incentives like 0% financing and generous rebates are no longer enough to entice wary buyers. Meanwhile, the question of government bailouts looms large. Many dealerships and automakers are hoping for a lifeline similar to the financial assistance provided to banks and automakers during the 2008 financial crisis. But public sentiment has shifted since then. Taxpayers are less inclined to support bailouts for companies they perceive as having acted irresponsibly, particularly those that pushed unaffordable luxury vehicles over practical and sustainable options. The lack of a clear, unified approach to addressing the car market's challenges has only added to the uncertainty. Policies vary widely from state to state, creating a patchwork of regulations that frustrate manufacturers and dealers alike. Automakers are left guessing about how to navigate the shifting regulatory landscape, from emission standards to financing limitations. The result is a market that feels increasingly unstable, with no clear path to recovery and mounting pressure for systemic reform. The consumer's role. While it is easy to blame dealerships, automakers, and government policies, consumers are not entirely off the hook. Buying behaviors during the pandemic created a ripple effect that continues to impact the market today. Panic buying, coupled with a willingness to pay inflated prices, encouraged dealerships to adopt aggressive pricing strategies. Now, consumers are reacting in the opposite direction. Burned by high prices and rising interest rates, many are delaying purchases or opting for smaller, cheaper vehicles. The shift in demand has been dramatic, with sales of compact cars like the Honda Civic and Toyota Corolla rising significantly while larger vehicles stagnate on lots. The financial strain on consumers is another major factor, with the average household carrying over $7,000 in negative equity and credit card debt climbing to record levels. Many buyers simply cannot afford to finance a new car. Those who do manage to purchase often face monthly payments that stretch their budgets to the breaking point. The combination of cautious consumer behavior and financial hardship has created a feedback loop that is difficult to break. As buyers retreat from the market, dealerships are forced to cut prices further, eroding profitability and destabilizing the industry even more. Dealership bankruptcies. Across the United States, dealerships are facing an unprecedented reckoning. For decades, these businesses thrived as the direct link between automakers and consumers, but the current market conditions are proving too much for many to withstand. As inventory piles up and sales stagnate, dealerships are grappling with skyrocketing costs, dwindling revenues, and an unsustainable financial model. When a dealership closes its doors, the fallout extends far beyond the lot. Inventory is typically reallocated to other dealerships within the automaker's network, often in more populated areas with higher sales potential. For rural or suburban communities, this means fewer options for purchasing and servicing vehicles, creating an additional burden for consumers who are already stretched thin. The economic impact is profound. Employees, from sales staff to mechanics, find themselves out of work, adding to rising unemployment rates. For automakers, the loss of dealership partners translates to fewer outlets for moving inventory, exacerbating their already dire overproduction issues. Dealership bankruptcies are not just a symptom of the car market crash, they are one of its most visible and devastating consequences. Opportunities for buyers. Amid the chaos, a glimmer of opportunity has emerged for savvy buyers. As dealerships and automakers scramble to clear unsold inventory, discounts and incentives have reached levels rarely seen before. Vehicles that were once unattainable for the average consumer are now being offered at significantly reduced prices, creating a unique window for those in a position to buy. For instance, mid-sized trucks like the Toyota Tacoma, which once carried price tags exceeding $50,000, are now being sold for as low as $45,000 after discounts. Similarly, high-end models like the Jeep Wrangler Rubicon and the Ford Bronco Raptor are seeing price reductions of up to $20,000. These discounts, combined with incentives like low-interest financing and cashback offers, have made certain segments of the market more accessible than they have been in years. Even luxury vehicles, which were once out of reach for most buyers, are now being aggressively marketed with enticing deals to clear inventory. However, these deals come with a caveat. Buyers must navigate a complex landscape of financing terms, hidden fees, and the potential for future depreciation. Vehicles purchased during a crash may lose value faster than anticipated, particularly if automakers continue to slash prices to move inventory. For those willing to take the plunge, the key is to focus on long-term value rather than short-term savings. Conducting thorough research, understanding loan terms, and carefully evaluating the market can help ensure that these rare opportunities translate into worthwhile investments. The industry's next moves. Automakers are painfully aware that the current trajectory is unsustainable. In response, many are beginning to reevaluate their production strategies and market priorities. The days of churning out oversized trucks and luxury models at inflated prices may be coming to an end as manufacturers pivot towards smaller, more affordable vehicles that better align with consumer demand. This shift is already underway in certain segments. Compact cars like the Honda Civic and Toyota Corolla are experiencing a resurgence, driven by their relatively low prices and strong fuel efficiency. Meanwhile, hybrid and electric vehicles are being reimagined to appeal to a broader audience. Automakers are betting that by offering more affordable and practical options, they can reignite consumer interest and stabilize the market. Another emerging trend is the streamlining of production. Companies like Toyota and Volkswagen are adopting leaner manufacturing practices to reduce costs and avoid overproduction. By building fewer vehicles and focusing on quality, automakers hope to restore balance to the supply and demand equation. For consumers, this could mean fewer choices, but greater confidence in the value of their purchases. A new era in car buying. The car market crash of 2025 is more than just a financial crisis. It is a turning point for the entire automotive industry. As dealerships close, inventories shrink, and automakers adapt, a new era of car buying is beginning to take shape. This transition is not without its challenges, but it also offers the potential for a more sustainable and consumer-friendly market. One of the most significant changes is the growing emphasis on affordability. Automakers are realizing that the days of endless price hikes are over. Future models are likely to focus on delivering value, whether through improved fuel efficiency, better technology, or lower upfront costs. Electric and hybrid vehicles in particular are expected to play a central role in this shift as manufacturers work to make these options more accessible to the average buyer. For consumers, the crash serves as both a cautionary tale and an opportunity. Those who can navigate the market's complexities stand to benefit from unprecedented deals, while others may find themselves priced out entirely. The key takeaway is that the car market is evolving, and buyers must evolve with it. By staying informed and adapting to new trends, consumers can position themselves to make the most of the opportunities ahead. As the dust settles, one thing is clear: the car market will never be the same. The crash of 2025 has exposed the industry's vulnerabilities and forced it to confront its excesses. What emerges from this crisis may be a leaner, smarter, and more resilient automotive market, one that prioritizes consumers and sustainability over short-term profits. The car market crash of 2025 is reshaping the automotive landscape in ways we've never seen before. Prices are dropping, dealerships are closing, and automakers are scrambling to adapt. But what does this mean for you? Are you planning to take advantage of the discounts, or are you holding off until the dust settles? We want to hear your thoughts. Drop a comment below and tell us, how do you see this crash impacting you as a buyer, a seller, or simply an observer of the automotive industry? Are these changes an opportunity or a sign of deeper trouble ahead? If you found this breakdown helpful, be sure to like this video, subscribe to our channel, and hit the notification bell so you never miss an update. And while you're here, check out the video on your screen for more insights into the future of the car market. Thanks for watching, and we'll see you in the next one.